All right, let's travel back to 1952 for a second. The recent Berkshire Hathaway annual shareholder meeting just wrapped up, and there was this one massive takeaway from our favorite investing duo, Warren Buffett and Charlie Munger, that absolutely stood out. But to really get it, we actually have to jump back over 70 years to this incredibly chaotic scene. Welcome to this explainer. Today we're unpacking a remarkable secret advantage that you actually possess, all because so many other people out there are treating the stock market like a giant roulette wheel.
I'm going to get rich. I mean, how can you miss if people are willing to do this? This is a land of opportunity. Now, you'd probably assume this super confident statement came from some slick Wall Street trader, right? No way. Those are the words of a 21-year-old Warren Buffett, and he wasn't on Wall Street. He was standing right in the middle of a loud, flashing casino floor. He was watching people literally throw their money away, and it triggered this profound realization about how to actually make money in the stock market.
So, let's set the scene here. It's 1952, Buffett just married his wife Susie, and they're road tripping down the West Coast for their honeymoon. But get this, it just shows how intense his dedication is. Buffett literally filled the trunk of their car with annual corporate reports. Yes, on his honeymoon. Anyway, they end up stopping at the famous Flamingo Casino in Vegas, mainly because a few investors he knew from Omaha had just bought a stake in it. And as he's walking around the Flamingo, looking at all these frantic gamblers, he has a massive epiphany about human nature.
Section 1. The Counterparty Concept. To really grasp what hit Buffett in that casino, we need to quickly look at the actual mechanics of the market.
Think about it. Every single time you buy or sell a stock, there's a counterparty on the other side, a buyer for every seller. Basically, you and this invisible person are having a fundamental disagreement. If you're selling, well, they think it's the perfect time to buy. And here's the kicker. That person on the other end, they might know something you don't, or maybe they don't.
So, quick pop quiz for you. When you hit that buy or sell button in your brokerage account, who exactly do you want on the other side of that disagreement? Like, who is your absolute dream counterparty?
Let's look at your options here. Would you want option A, a totally uninformed participant who just ignores the company's fundamentals, or option B, someone like Warren Buffett? Obviously, I think it's safe to say we'd all be pretty terrified to bet against a financial genius like Buffett, but we'd absolutely love to take the other side of a trade against someone who's just blindly gambling. And that brings us right back to 1952. Buffett noticed the folks in that casino looked way more prosperous than he was. Some had traveled across the country just to play a game that was mathematically rigged against them. And it clicked. In the stock market, you can find people playing those exact same rigged games. And as a smart investor, those uninformed gamblers are exactly who you want on the other side of your trades.
Moving on to Section 2, today's market casino. Because listen, if Buffett thought the market was full of gamblers in the 50s, well, it's nothing compared to what we're dealing with today.
Right now, there's arguably more pure gambling in the stock market than ever before in history. I mean, you just have to glance at the Wall Street Bets crowd or the massive waves of crypto enthusiasts to see it. The whole idea of steady, long-term gains, totally thrown out the window. People want excitement. They want overnight riches. They're basically the types who'd rather chase two birds in a bush on the other side of the planet than hold on to one safe bird right in their hand. They aren't making informed decisions. They are just spinning the roulette wheel.
And the data backs us up big time. According to Refinitiv, back in the late 1950s, the average holding period for a stock on the New York Stock Exchange was 8 years. 8 whole years. Today, that average has completely nosedived to just 6 months. People just aren't buying businesses to hold and grow anymore. They're frantically trading digital lottery tickets, crossing their fingers that someone else will pay a higher price a few weeks down the road.
Buffett actually has this completely hilarious way of describing this behavior. He says, calling someone who trades actively in the market an investor is like calling someone who repeatedly engages in one-night stands a romantic. You have to love that. It perfectly hits the nail on the head regarding how absurd it is to treat short-term, hyperactive gambling as a serious investing strategy.
To put it another way, back in the 50s, people treated their stocks like true gentlemen, right? They made a commitment. They got to know the company, and they stuck around for the long haul. Today, for so many active traders, stocks are basically treated like a Tinder date. It's this whole swipe culture mentality, but applied to life savings. Anyone investing with a 6-month horizon is playing a totally different game than the fundamental value approach that built Buffett's empire.
Which brings us to our final section, the fundamental investor's advantage. Now, Charlie Munger often pointed out that treating the market like a casino is pretty awful for society as a whole, but it actually hands you a massive built-in advantage.
Let's look at the math for a second. Historically, the stock market returns roughly 8% a year. Now, 8% is great. That builds serious wealth over time.
But Buffett and Munger are crystal clear on this. You can actually do a lot better than that. Why? Because thanks to all these modern apps, the market is completely flooded with uninformed participants. You have this incredible opportunity to buy from and sell to people who literally know nothing about the underlying businesses they're trading in. Munger bluntly said, "I think we've made more because of the crazy gambling." And Buffett's response? Just a simple, "We've depended on it."
So how do we actually use this in our own lives? Here's the actionable game plan. Step 1, block out the noise. Completely ignore the hype-promising overnight riches. Step 2, just let those uninformed counterparties treat the market like a casino. Let them play their mathematically rigged games. And Step 3, exploit that impatience. Stick to a fundamental value approach, buy up solid, wonderful businesses when the gamblers are panic selling, and sell to them when they're in a total euphoric frenzy. As long as people are willing to act this way, the opportunities are going to be endless.
Which brings us to one final, really important question to leave you with today. I want you to take a hard look at your own financial habits. Are you treating your portfolio like a business, carefully analyzing fundamentals and looking years into the future? Or are you, maybe without even realizing it, sitting down at the modern market casino? Don't be the gambler at the Flamingo. Be the person with a trunk full of annual reports just waiting to take the other side of their trade. Thanks so much for joining me for this explainer, and I really hope this gives you a completely fresh perspective on how to use market chaos to your advantage.